So, guys, you are all welcome to our second lecture. And this lecture tends to look at IFRS 13. We will be looking at IAS 1, and we will also start something under IAS 16. We begin from where we ended last week, where we dealt with the conceptual framework. If you remember, we did conceptual framework. And chapter 6 of the conceptual framework, we learned measurement. And please, this is an examinable area. We learned measurement. And we said that measurement is what? Giving the event monetary value so that you can actually record. Accounting records economic transactions, not any form of transaction. We are talking about economic ones, those that we can actually place value on them. All right. So we learned measurement. And there are two major measurement approaches or criteria that, according to the conceptual framework, we should know. And under one of it, it also gave us three. So if you remember, we said that the standard says we should use historical cost. We can use historical cost. And we said that historical costs help us with reliability. It's very reliable. But it is not relevant in today's decision making. Why? Because if I want to sell my land now, I'm not going to sell it at the price I bought it like 10 years ago. I need to kind of give it the current value. So the next one, the conceptual framework talked about was the current value. The current value. And this one is the one that is under relevance. So I explained to you something called the trade-off between reliability and relevance. Because if you use the cost system, the historical cost system, it is reliable. Why? Because you have the invoice there, you can pick it up. But when it comes to the current value, it is some way subjective. All right, it is some way subjective. We need to get a value for it. And therefore, even though it is relevant, it is not reliable because it is kind of a negotiation. If you want to sell the thing now, you don't really know the price because you are going to inflate it, and it makes it a subjective situation. Okay, you did the inflation of it because you think that things have gone up. I bought a car before at 27,000 Ghana cedis, a VIT. That is 2020. All right, year 2020. Now, what happened is that COVID had come, everything has come and gone. Now, you see, prices of cars have increased now. Can you imagine that car that I bought at 27,000? If I want to sell it now, can you imagine that I am able to sell that car at 35,000 Ghana cedis? Because things have gone up, inflation gone up. So it is my subjective valuation. I don't have any invoice that says that I bought the car at 35,000. The invoice that I have says that I bought it at 27,000. And the fact that I can actually now sell it at 35,000 is telling you that I am placing the current value on the car at 35. So that is what has happened. So the current value, the conceptual framework told us that if we want to use the current value, there are three out of it. One of them is fair value, and that is what we want to learn today, fair value. Okay, fair value. And fair value is governed by IFRS 13. So that is what we'll be learning today. Okay, so I won't speak much about it now. Then it also said that we can use the current cost. Current cost. Please don't confuse current cost with current value, please. Current cost is how much it will cost me to replace that asset, not to sell. How much it will cost me to, if I sell the asset, how much it will cost me to replace that asset. So that is what we call current cost. Now, under current cost, we have two. In fact, the first one, it depends on whether the company is on a going concern or the company is not on a going concern. If the company is on a going concern, then the current cost you can use is called the replacement value. The replacement value. Because you are going to, the cost that you are going to incur in replacing the asset, right? When the company is on a going concern. In fact, we say replace it because the company is on a going concern. All right, that is the meaning. If the company is not going to continue to operate, we will not replace it. It means it starts to be off because it won't be there for us to even continue the business. So if the company is on a going concern, we use replacement cost. And I always say, those of you who have done public sector or will be doing public sector, you realize that at some point you'll be valuing inventory. It is always in your question like that. They will give you the replacement value. They will give you the realizable value. Then you have to determine which one to use. Basis the fact that is the company on a going concern or the company is not on a going concern. That is where you need to understand it from. Another name for replacement value is what we call fulfillment value. Fulfillment value. So if you don't see the replacement value, all right, then look at fulfillment value. We say that you will need this when the company is on a going concern. Take note of that. Now, when the company is not on a going concern, I've already given you a clue. Then you have to use what? The realizable value. Remember, I told you under conceptual framework that if a company is not on a going concern, valuing that company, we use the breakup basis. Breakup basis. So that is, and under breakup basis, sometimes you are going to use the realizable values, that which you will get. All right. So that is that. Then the third one that we learned, so we said the current cost. So the second one, sorry, under current cost will be what we call, so I've said that current cost, we may have replacement value or realizable value and fair value, right? So the third one that we will talk about is what we call value in use. Value in use. All right. Value in use is the present value of the future cash flow from the assets, the future cash flow from the assets when the company uses it itself, when the company uses the asset itself. So now, these are the three current valuation that you can do, all right? Of course, it is at that point we learn something about, what do you call it? Those things that we used to do under current cost, CPP and what do you call it? In the olden days when we were doing ICA, we used to have some technical names for these kind of things when we want to value. We used to have current purchasing power, or what we call constant purchasing power. We used to have what we call the current cost accounting, where we use the deprivable values and all those things. I mean, these days we've gone past those days. So we stick to these three. All right. So now that you know the measurements criteria, we are going to pick them one by one and be learning it. Of course, the first one is fair value. So we are going to start fair value today. Current cost, where it can be realizable or it can be replacement. You will see more of those things when we are doing something like IAS 16 and IAS2 inventory. These terminologies will come up. A value in use to, it is seen most of the time in IAS 36 when we want to calculate impairment. So we will meet these terminologies in future. Now, let me go straight and go into fair value. And I need you to pay apt attention. So today we want to look at IFRS 13, fair value. Fair value. All right. So that is what we want to look at. Now, what is fair value? So in all the standard, like the way I'm going to approach it, we are going to define it. And once we have the definition, we will break down the definition. And that is where we will get all our understanding that we will need. Okay. We'll break down the definition. So what is fair value? What is fair value? Now, if we talk about fair value, the word is fair and value. So don't kill yourself in trying to memorize certain kind of definitions. All right. If I am selling something to somebody and the person is also buying from me, there has to be the price that is fair to both of us. Okay. So somebody once said that fair value is just an accepted value between two parties who are in a market transaction. All right. The value that is acceptable between two parties that is in a market transaction. But this kind of definition has some shortfall. So when I give out the definition and we analyze it, you realize why I say this kind of definition has a shortfall. Because in your exams, they are going to bring in those shortfalls just to trick you on certain things. Now, watch this. When we say a fair value, we say fair value is the price. So the focus here, we have one thing, price. We will look into it, what the price, how we get the price. So it's the price that would be received to sell an asset. Price that will be received to sell an asset. All right. Or transfer a liability. Okay, or transfer a liability. And watch this. These are the key terminologies. In an orderly transaction. In an orderly transaction. Orderly transaction. And that is a very key thing. Orderly transaction. In an orderly transaction. So let me underline that. Orderly transaction. Between two market participants. Between market participants. It can be more than two. Market participants. So let me just highlight that one too. Market participants. Wow. All right. It's okay. So between two market participants at the measurement date. The day you want to measure the transaction at the measurement date. All right. So this is the definition for IFRS 13 fair value. Okay, fair value. Now, we need to pick out the things in the definition and analyze them one by one. All right. But by the time we finish analyzing it, then you know that you understand what fair value is about. We will solve 3 questions under this one, and you appreciate it. Now, watch the definition. We said the fair value is the price that would be received to sell an asset or transfer a liability in an orderly transaction between market participants at the measurement date. The first part I want to pick out and explain in this definition is what we call market participant. Market participant. Now, when we look at the market participant, the standard tells us that the market participants are knowledgeable third parties. So normally when I am defining it, I add the knowledgeable in between two knowledgeable market participants or between knowledgeable market participants, because the market participant has to be knowledgeable. Now watch this. I was born in Kumasi, and there is a trade skill in Kumasi. If you don't know, you buy something not at a fair value because you are not knowledgeable. If you want to buy something at a doom, especially, and you go there and you say, oh, please, I want to buy this shoe. Please, me patrol, ne boy is saying, since it's Kumasi, it's cheap. Ne boy is saying. The moment you ask ne boy is saying, the person looks at you, and it is your appearance he's going to use to price the product. Your appearance. So he looks at you, he sees that you are naive in the market, then he quotes you a higher 3 times the value. That is what they do. They quote you 3 times the value. And you will ask for a bargain. Oh, please, can you reduce it for me? Can you? So if it costs 3 times the value, let's say the thing is actually costing like 10,000. But when he sees you, because he sees you are not so knowledgeable in the field, he will say the price of the thing is 30,000. Then you will say, oh, ne boy, so he will say 25,000. Then you say, oh, I beg you, I beg you. Then lastly, you say 20,000. Then you will say boy again. Then you will turn and you will be going. Then he will call you, oh, they're for 15 budget. At that point, you feel like you've gotten him and you buy it at 15. He has actually cheated you 5K on top because you are not knowledgeable. All right. Now, personally, this is my experience. So I go there. Once I go, I pick the shoe. Then I give you 10,000. That is what I do. I go there and I give you 10,000. Then I take it, I'm going. You see that they will look at you and say, hey, that is what I do. Even in Accra here, we have our brothers who sell shoes at the spanner, the overhead at Accra roundabout, Accra Mall. Anytime I want to buy shoes, and these days, that is the place I've decided to buy, because the ones that I buy for 500 cedis, one for 500 cedis, I have realized that I can actually buy like two from those guys, which will even be less than 500 Ghana cedis, and exchange the wearing, okay, so that it can last long. So that is the technique I've decided to adapt, because the francophone shoes that they bring, well, the UK ones are tough, but if not for if it is for going to work every day in and out, come on, just get the francophone ones be and go your way, and get one or two, three UK ones be down. All right. So when I go there, I bought like 3 shoes from them. When I go there and I'm buying, I just take the shoe and I give them 180 cedis. And they are like, hey, akwa we pa as only market anymore. That is how they go by their language. Okay, so you need to be knowledgeable. So the market participants we are talking about, the standard says that those market participants are actually knowledgeable. We don't use those people who don't know the market. If they don't know the market and those things happen, it means it is not a fair value. So knowledgeable third parties, these are what we are talking about. All right. Why? Because these knowledgeable third parties, when they are pricing something, they consider 3 things. They will consider the location or the condition first of the asset, the condition. Number 2, they will consider the location. Number 3, they will consider the restriction on the use of the asset. And that one will help us, or will help in determination of the fair value. All right. So, for example, I told you that when I'm buying shoe from Cantamanto or Community 11 Temarasta, it's different from when I'm buying at the Accra Mall. Why? Because I check the condition of the Accra Mall shoes. In fact, the Accra Mall roundabout shoes, if you buy them and you don't give it to a shoemaker to sew the round down, you will regret it. So I know the condition. Number 2, I know the location of the asset. For example, a land in East Legon is priced differently from a land in Tema here I live. All right. So the location also affects the price. And the restriction on use, like I told you, if I go and buy the shoe at the roundabout there, and I don't give it to the shoemaker to sew the rundown for me, you will be walking and you see that the thing has opened its mouth. That is what you will see. So I know the conditions, I know the location I'm buying the thing is not countermantle, and I know the restriction of use of the asset. All right. And that one alone makes me knowledgeable, because that is what I will consider. So anytime you see in a question, check these things. All right. Please, I've already told you that financial reporting is not mathematics, it is law. And the application of the law helps you in the positioning of the figures. So we are learning the law now, so be careful. Now, the next terminology we need to look at in the definition is the one that is, say, in orderly transaction, in an orderly transaction. Orderly transaction. Orderly transaction. Now, orderly transaction, what does it mean? It means that the market participants are not forced into the transaction. All right, so market participants, this one means that market participants are not forced. The key word is that they are not forced into the transaction. And please, in the exams, be careful of IAS 24 combined with IFRS 13. IAS 24 is about related party transactions. So you see that the parent has control and it is forcing the price on the subsidiary. When that one happens, you have to be using the fair value. So you have to look for the fair value. You will be learning how to look for the fair value very soon. All right. So it means that the market participant, one, is not suffering from cash flow. They are not suffering from cash flow shortages, because see, sometimes people sell their things because they are short of cash flow and they want any price of it for the thing to go. That valuation is not an arm's length transaction. It's not fair value, because nipa no ho akyere no nti price bi awaje. It doesn't mean that is the fair value. That is why I told you that the definition that says that the price that is acceptable between the two of them doesn't really depict fair value, because in a fair value, there has to be orderly transaction. You don't take advantage of somebody's weakness, all right? It's not fair. All right. So I say here again that number two, there should be no compulsion, all right? No compulsion from controlling entities. No compulsion from controlling entities. So related party, check these things out when there is a related party. We will do related party and you see that there will be so many values. And because you have learned IFRS 13 fair value, you'll be looking for the real value to price the thing. All right. So that is that. Now, let me sound this. Let me do this quickly before we come to the price. All right. The price here and the price in the market. Now, what you need to understand is that we use IFRS 13 has its scope, all right? It has its scope. So, and that is the place I want to correct in some of the videos, all right? The scope is such that we use IFRS, it is actually used in IAS 16, PPE. We will be learning PPE, all right? You see that we will have to be using it. And we also use IFRS 13 also in what we call IFRS 3, which we will be learning very late in our course. IFRS 3, sorry, it's called business combination. And that is where we used to do our consolidation. So when we are doing business combination, we will be applying the IFRS 13. But there is a limitation on the use of IFRS 16 on standard like IFRS 2. IFRS 2 is share-based payment, and there is a limitation on the use of IFRS 13 in IFRS 16, which is leases. So this is the part I want to clear out. All right, so that is that. In fact, I can dare say that it does not apply to IFRS 2 and IFRS 16. So that is that. Now, that cleared. Let's look at the approaches, okay? Approaches of determining fair value. Now, you understand something about fair value, but now let's look at the approaches of determining fair value. The approaches we actually have three approaches of determining fair value. But we will stick to one of them. We will stick to one of them. Now, the first one is the market approach. The market approach. And in the market approach, our focus is that the valuation is based on the recent prices that you have in the market. The valuation of the asset will be based on the recent prices in the market. All right, so that is that. Then we have the cost approach, the cost approach. You will realize later, let me finish this one and open your eyes to something. the cost approach. So if you remember what we did, we mentioned under the current value, we mentioned IFRS 13 fair value. So IFRS 13 fair value is actually for this. So this is where we'll be focusing on, the market approach. The cost approach is linked to the other one, which I call the current cost, if you remember. So that one is based on replacement. So here the cost approach is based on replacement value. So see, these are not things you have to memorize. You can actually connect it to what we learned in the conceptual framework. What do you think the income approach will be based on if you connect it to what we did in the conceptual framework, that which I even started the class with today? Which one do you think the income approach will be based on? Yes, who can? Yes, per what we've done today, per what we've seen today. If this one is for IFRS 13 and this one is kind of the replacement cost, what do you think this one will be based on? Yes, anyone? Let me see a hand raised. Yes, anyone? Yes, Rampa.
Yeah, net realizable value.
No. No. Yes, who else?
Replacement cost.
I've already written the replacement cost. I'm asking for the income approach. Yes, who else? Okay, I have something in the chat. Somebody said the consideration. No, Makafui. Not the consideration. Who else? Yes, who else? Rampa, your hand is still raised, or it's just for the contribution you just made. If not, you can lower it down. Yes, who else? All right. It is the value in use approach, which was based on future cash flow. So based on the financial forecasting, if you remember, that is what we said. So there were three: financial forecasting. All right. So these are the three approaches to determining fair value. But please, the aim of fair value, the aim, why are we learning fair value? Please understand it, because if you don't get the basic fundamental reason why we are doing this, you miss it out. The main aim we are learning fair value is to estimate the price. It's an estimation. It is not the concrete price. We estimate. The main aim is to estimate the price. Okay? That is the main aim, because we already have historical cost for the thing, which is reliable. But I told you, if I bought a building 2 years ago, and see, sometimes I really want students to appreciate the fact that these things we are learning, it is not book before life. It is not the book that is determining how we live. It is how we already live that has been translated into a book. So if you don't see your environment and understand what we do in connection with what you have in the book, and you feel like museum book, it won't help you. It will make it difficult for you. There is nothing that we've said here that you have not seen in your real life. There is nothing. And I've done my best to actually use personal experiences for you. There is nothing you have seen here. You work in companies. You know historical costs because you can go out in your files and pick the invoice for it. So it's not like, hey, what is historical cost? No, 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 no. These things are things that are surrounding you. So don't push your, hey, okay, I like this book, this terminology, this, that. No, 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 no. If you take that approach in your learning, you have already failed. Yes, that one, I won't lie to you. You have already failed. So it means that if you go into the exam and you see a word which you didn't see in a book, it means you can't write. I mean, then how ready are you to become a chartered accountant? If you have heard the former CEO of the ICA before, he said that for you to be a chartered accountant, you should be beyond average student too. So you should be able to think, use your brains. All right. So that is that. So please, what we want to do is to get relevance, fair value. That is what the reason why we are doing all these things. And you know that, in fact, haven't you sold something of yours before? How was it valued? Come on, you know all these things. So please, sometimes you need to connect to the natural life. In fact, not even sometimes, all the time. All right. Everything we are doing is a realistic thing. It's not an abstract. All right. So what we are saying is that these are the approaches to fair value determination. Now, if that is the case, we said that IFRS 13 is using, out of these three approaches, the market approach. So the market approach is what we are going to use, the market approach. All right. In public sector, they can stick to the cost approach and all those things. But here in IFRS 13, our focus will be on the market approach. Okay. So now, the market approach, so the fair value of determination we are using here will be the market-based one, not the entity-specific. This one is the entity-specific. This one is the entity. These ones are entity-specific, because it will be the cost that entity think he can replace the asset. Income is based on the future cash flow of the entity using the asset. So these two are the cost or the entity specific. So the IFRS 13 is focusing on, so we said that this one is entity specific. The IFRS 13 is based on the market specific. All right. So in the market specific, we will be using the market approach. So now, the market approach says that the market-based measurement is what we are using. That's the market approach. What does it say? The market-based approach tells us that we are going to use observable data from the active market. So we use observable data from the active market. So if I want the price of something, I will need an active market, and I will use the observable data. If you want the price of tomatoes, go to Ashama market, you get. And we will learn something small about the market, and that is where we will probably be ending the thing on IFRS 13, the market. It is not every market that we are talking about here. Now, watch this. We use observable data from the active market. Now, what is an active market? Active market is a market where there are a series of transactions of assets and liability. There is frequency, okay, where the transaction for assets and liability occur frequently. Please take note of that. Okay, so we say where transactions for assets and liability occur frequently. That is it. As a matter of fact, active market is a market that is homogeneous. We need homogeneous. So what we say is that there is a frequent trading of one commodity, a specific commodity. If you want fish to buy in Kumasi, you go to Bode Market. If you want shoe to buy in Greater Accra, you go to Kantamanto. If you want onion to buy, it used to be Agbogboloshi. Those of you who know there. All right. Every market has a specific name for it. Okay. When I came here in Tema here, I realized that if you want to buy a wood for your construction activity, they said there's a place called Ashaman Runabout. But I was born in Kumasi, Anoga Junction. So if you wanted wood to buy, you go to Anoga Junction, or these days you go to Sokoban Wood Village. So you see, there are specific markets for specific things. So that type of market is what we call active market. Okay, that is the market. Okay, so that is it. So we said that where transaction for assets and liabilities occur frequently, and I also said that where it is a market where there is a homogeneous trade of commodities. So note that. All right, of goods and services. and to the extent that the prices are publicly known. Prices are publicly known. All right. It is not hidden. It's publicly known. All right. So take note of that. It's publicly known. Okay. Because if I want to go to Sokoban Wood Village, the prices are there. Clear. It's clear. All right. So that is where I say that if you go to the Edu market and not knowing your price before you go, the way they will treat you, you salute them. You salute them. So in an active market, that is there's characteristics that you see of the market. Okay. And so when we are getting our data for the valuation, we will need to classify the input. And this is where they examine you in your exam. So we have three classification of the input for the valuation of this. You see, you need data from the active market. So now watch this, and this is the most important part of what we are doing now. So the classification of input, is where it gets interesting. Okay, so there are three levels, all right, of the input. So we have here, we have level 1 input, level 1 input. What is level 1 input about? Level 1 input says that we will use input of quoted prices for identical asset. And what are identical assets? And the identical assets should be in the active market. So we use identical prices for identical assets in an active market. Please, I'm not saying these words from my mouth just for you to listen, but for you to actually get it in your mind, because this is where it gets tricky for your examination. So you will use the prices of identical assets in an active market. When we say something is identical, what does it mean? Look at twins. The things that make something in identical is that they have the same features, but most importantly, what distinguishes an identical for similarity is that they come from the same source. The same source. That is why we can say twins are identical, because they come from the same womb. But you see, if you see, you've also heard, hey, Akwawe Ose Asimesio. That is similarity, okay? They don't come from the same source, okay? But they look alike or something, all right? So they don't come from the same source. The only thing that distinguishes the similarity and identical is a matter of source. So we say level 1, use quoted prices for identical assets in an active market. Okay, listen, I want to buy, please, who is that? The person should mute. I want to buy, Grandpa, kindly mute, please. I want to buy a car. Watch this. A car, and it's Toyota. Now, when I go to Toyota, okay, the car I want to buy is Toyota Yaris, long boot. Those of you who know cars, long boot. I can go to Toyota and get the same manufacturing year, everything of Toyota, two. So if mine, like I had one, if mine is missing and I want to value, or if I'm selling mine and I want to value that mine that I'm selling, I can actually go to Toyota and use the price of what Toyota has, all other things being equal, i.e. condition, location, restriction of use. I can use any other Toyota car that is in the same range of mine to price the one that I'm selling. Okay, So all other things being equal, if I want to sell mine and I really don't know the price, I can know, and somebody's own is having the price, which is identical to mine because they all came from Toyota. I and Toyota, let's say US, I can actually price my car using the value of the other person's price. Have you seen it? Have you seen what we are talking about? So basically, that is it. That is what we call identical. If my laptop that I'm using is now 4 years old and it is HP, it is Core i5 8th generation. If I want to sell it now, I don't really know the price I should put on it. So if one of you, let's say Rampa, also has Core i5 8th generation laptop, and Rampa's own is also used for 4 years, and Rampa actually has valued the thing like, let's say 5,000. I can actually, based on his data, and also price my own at 5,000. That is why we call identical, because the thing, it came from HP. It all came from HP. So that is level 1. But it has to be in an active market. So that is the most important thing. It has to be in an active market. The observable input here we are talking about of the identical asset have to be in an active market. If there is no active market for this quoted price of identical asset in the market, then I am going to resort to the next level. Okay, that is where we go on to do level 2 input. So the next one is level 2. Level 2 input. So the level 2, we are going to use what we don't have in level 1. Okay, what we don't have in level 1. So in level 2, we are going to use observable prices that are not in level 1 input. So here we use observable prices, not in level 1 input. Now, what are the observable prices not in level 1? One of them is the quoted price. So we will take the quoted price of similar asset. And please, similar asset means that they have the same characteristics and everything, but it's not coming from the same source. All right, similar asset in an active market. So here, similar asset in active market, or plus quoted prices of identical asset in a less active market. Identical prices, identical asset in a less active market. In less active market. So take note of that, active market. Then the last one we will add up is observable inputs that are not prices. Observable input. These inputs are not prices. And I'll give you an example of that. Observable input that are not prices. Example is the interest rate. Interest rate or inflation rate or whatever you call it. Now, watch this. I told you I bought a car for 27,000. Now, if I am selling the car now, all right, I told you that I'll sell it 35,000. Now, watch this. Because the car, in fact, I hardly had a quoted price of an identical car to mine that was in an active market, I had to resort in this one, level 2. The level 2 meant that I will get a similar car. Mine is from, it's a VIT from Korea. Now, it passed through Dubai. They brought it from Dubai. Now, watch this. The car that I had, it has so many similarities with other VITs, but it sounds like my own was so special. It was very strong. In fact, the company that I worked in, people bought similar VITs, but everybody's own had problem except that one. It was so strong, very, very strong. When people are changing what do we call it? This thing in the steer. You steer rack. Yes, people are changing the steer rack of their car. My own was strong. Now, so pricing that, I had to use a similar car in an active market to price that, and also check price in the price of the same car in places where they are not selling frequent cars. The asset, the trading is not frequent. Plus time value of money, the fact that things had gone up and interest rate had gone up, inflation had gone up. That is what shoots the price to 35,000. So that is the determination of the fair value at the point of level 2. Then per standard, if you don't know the level 2, if you can't get level 2, then you go to level 3. I'm going to show you something for you to make it easy for you to ask in your brain once and for all. The level 3 says that use inputs that are unobservable. Inputs that are unobservable. Unobservable. And here, what we are talking about is the cash or the profit forecast. Cash or profit forecast for using the asset yourself. Now, I have something for you. You see, we learned level 1, we said identical, active market. That should give you an impression of fair value. You remember. Then we talk about level 2. Level 2, we are saying quoted price not listed in level 1. Level 1, and we say quoted price of similar asset, quoted price of what that picture should give you is what we call the replacement. And then level 3, who can tell me what that picture is giving you? Given the fact that we are using forecast when you use the asset, what picture is it giving you? For what we've learned so far, yes, what picture is it giving you now? Yes, Augustine. Augustine, go ahead. Have you muted yourself? I can't hear you.
Oh, sorry. Value in use.
Value in use, exactly. So it gives you the picture of value in use. Okay, so that is that. All right. But you see, when you are doing the levels valuation, if you are checking this, priority must be given to, it's ranked like this. The priority must rank from here to here. So if you don't get level 1, that is where you get to level 2. If you don't get to level 2, that is where you get to where? Level 3. You can't start from level 3. So please, the key is that the lowest priority is given to level 3. Is given to level 3 input. So you can only use level 3 input when you can't use level 1, neither can you use level 2. But if you can't use level 1 and you have the choice between level 2 and level 3, then it means you stick to level 2. It is when you don't have these 2 levels, that is where you are stuck with level 3. So in the exam question, what they do is that they will give you case, and in the case you realize that, I say you are stuck between level 2 and level 3. And the level 3 is always giving you the right picture, but the standard says that the priority must be given to level 1 before you come to level 2, then lastly you come to level 3. That is the key. Please keep this one in your head. All right, be careful. All right. Now, that is that. Okay, so the last thing I'm going to talk about under IFRS 13, which this thing has been interesting. IFRS 13, then we look at some figures, is the fact that let's look at the market. We were talking about the market, and I gave you some illustrations, the market. Now, the market, we say we use active market, and we've explained what an active market is. There are 2 forms here that we want to look at. We call one the principal market. The principal market. And in the exams, look for that. The principal market is always in line with the active market. And they will give you something we call the most advantageous market. And that one is usually connected to the level 3 things. Most advantageous market. You need to understand the difference between the two. Principal market is like the agbogloshi market for the onion purchase. So we have the market that has the greatest activity of the asset or liability being measured. Okay, so here the market is with we say it's with the market with greatest activity. So when you go to agbogloshi market these days, I realized that they've moved them to the Cape Coast Road, somewhere along the line, for assets or liability. There is a graded activity for the asset and liability, all right, that you are measuring. Please, if you forget anything, it is the principal market. I say that the principal market for the same asset can differ, all right? It can differ. If you want onion market, you go to agbogloshi. So example, onion market, agbo. How do you spell agbogloshi? All right, so you can go there for that. Now look at the most advantageous market and how tricky it is. The most advantageous market is the market that maximizes. So we are looking at the market that maximizes the amount received from selling the asset, or so maximizes the amount received from sale of asset. Okay, or the lowest amount received, the lowest amount for transferring liability, So that is that. Now watch this. The word is maximize. So in that market, they want to maximize how much they will receive. Okay, how much they will receive. And in that market, you will see things of the maximization actually is emanating from the fact that there is transaction cost. There is transaction cost. I know you know transaction cost. Example of that one would be the legal and the brokerage people. All right, the person who is doing the brokerage for you. All right, you see, you pay this person, you pay this person, you pay this person, you pay this person. These are the things that is playing a major role. The transaction cost is that which is playing a major role to make the thing advantageous. All right, so to maximize that thing, it is coming from them. But you see, when we are using fair value, the fair value that we are using, we need to adjust for those things, because that transaction cost is a function of the market, not the asset. We are pricing the asset, and so we can't add transaction cost to those things. See, at the end of the day, so hold on, I say that the fair value is not adjusted for transaction cost. So what we intend here is that, so sorry, adjusted for transaction cost. Transaction cost. Not adjusted for transaction cost. Now, what you are seeing here is simple. We are saying that the transaction costs are a function of the characteristics of the market rather than the asset itself. The asset doesn't have a problem in its fair valuation, but because of all these things coming, the transaction cost plays a role in deciding which market is most advantageous. However, the fair value is not adjusted for transaction cost, because why? The transaction cost is a characteristic of the market. It's a function of the market, a function of market, but not the asset. Because the asset, it is ready. But because you see this middleman, the price of the asset, those things help determine the most advantageous market. So that is what happens. That is what happens. All right. These are the market we are talking about is the place where the transaction is taking place. But so, and we are saying that the market where you get the price of the fair value has an effect on the price. Okay, depending on whether the asset is sold at what we call a principal market or the most advantageous market. So the entity is able to, if the entity is able to access a principal market, you will realize that the prices of that thing is better. But if you don't have a principal market for that, then you are stuck with the most advantageous market, where you are going to suffer from this kind of transaction cost also there. All right, ladies and gentlemen, the last thing probably I want to bring to your attention is how we look at financial and non-financial assets for this time, for this fair value concept. So let's try and conclude something on non-financial market and non-financial asset and financial asset. We know that asset can be classified into NCA and CA, but we also know that there is a non-financial asset. So there can be financial assets and non-financial assets. How do you price those ones? How do you use fair value in terms of talking about these ones? When we talk about financial assets, I know you know financial assets, these are financial assets. And please, whenever the word financial come in, I want you to have the picture of whether the thing can be in a financial institution or not, okay? So those ones that can be in a financial institution, financial assets, includes things like, I'm going to ask you this, investment in shares is a financial asset because you can use the financial institutions for them, all right? So investment in equity shares, it's a financial asset. What is the meaning of this one? Contractual rights to receive cash. What is the meaning? What is that? A contractual right to receive cash means what? It means what? A contractual right. You have the right to receive cash from somebody. What does it mean? What does it mean? Yes, who can try? What one word explains that? A contractual right to receive cash. What is that? Under what circumstance will you have a contractual right to be receiving cash from somebody? All right, receivables. Receivables. Thank you. Receivables. So that is what we mean by a contractual right to receive. A typical example is that. For non-financial market, a typical example of non-financial asset is PP, not at the bank. Intangible asset. Inventory. All right, these are all non-financial assets. When we are doing IAS 21, IAS 21 call them monetary assets and non-monetary assets. So that is that. Another name for these two are that. All right, monetary assets and non-monetary assets. Now, when you are valuing this non-financial asset, you should use the best and the highest use. Best and highest use. If you are doing corporate reporting, best and highest use, you would realize that there's something called business valuation. And you realize that in terms of valuing the intangible asset, there is a best how much you can get from it. So you use an annuity of the future cash flow, all right, to determine the values of those ones. So the highest and best best use of the asset is what you based on to value the asset, okay? And in that one, you analyze them. Your best use of your asset is analyzed into the physical possibility. How strong is the asset to be used possibility? Then you come to the legal permissibility. Is it allowed? But here the standard says that the legal permissibility is there even if it is illegally approved, okay? Even if it is not legally approved. So it is there. So we talk about the legal permissibility. Is it legally permissible? Then we talk about the financial feasibility. All right. So these are the things that you are supposed to know in IFRS 13. So ladies and gentlemen, that is that. Let's look at the typical figurative question. So once you see it, and I need you to crack your brains here. From all that we've learned, we are coming to apply it to the figures. So that you check out in your questions. I have like 3 questions for you. All right. So from everything that we've said over an hour now, get ready, especially the level 1, the level 2 concepts that we discussed. All right. So now it is coming to get interactive, and I need you guys to actually contribute. So let's pick up this question. I have a nice past question for you. It's a very simple question, and I'm sure you'll be able to deal with it. Simple. All right. Question is coming up shortly. All right. So we have Gonja Limited. It's an investment company which holds a portfolio securities linked with real estate market in Ghana. The following information is available on 31st July 2018 regarding this portfolio. And watch this. It says that the portfolio cost 30 million 2 years ago. If I were you, I'll put that one down. 30 million 2 years ago. Now, it says that point 2 says that the real estate prices in Ghana are generally accepted to have dropped by 20 to 30% in the past 2 years. Point 3 tells us that the portfolio of security held by Gonja is difficult to value, very, very difficult to value. And there are no active market. If I were you, I'll also underline that, no active market. However, the company has received an offer 2.6 million for this portfolio from an investor. It has no intention of accepting this offer, although similar companies, if I were you, similar companies have accepted offers from this investor due to financial difficulty. All right. And it says that a normal sale in the present climate could reasonably be expected to yield 6 million based on analysis of transactions of similar assets. If I were you, I'll underline that because these things should ring a bell. Is that not it? All right. Gonja's valuation model suggests that real estate market in Ghana will recover. Will recover is a futuristic statement. So that one too should ring a bell. And it expects that the portfolio will generate 12 million in present value over the next 3 years. That thing should also ring a bell. You are required, and it's 5 marks. In accordance with IFRS 13 fair value measurement, advise Gonja on the amount it should state its investment portfolio in its financial statement at 31st July 2018, assuming it wishes to use fair value method, fair value as measured. So is it okay? Have you gotten the picture of the question? The concept of the question? Is it okay? Class, is it okay? I need your responses, please. when a question is asked. Hello?
Hello.
Please, are you with me? Let me know if you are with me or not.
Yeah, we are with you.
So,
Hello.
what do you get out of the question? What is your approach to answering this question? It's 5-mark question. What do you say? Per what you have learned, not your own. We are learning standards. So the word said in accordance with IFRS standard, not in accordance with what you have in your personal mind or anything. In accordance with the IFRS standard. Yes. If you have been following me systematically, you should be able to answer this question. Yes. So who is willing to share an opinion? So yes. Makafui, let's go. Yes, I'm listening. I'm ready to hear you.
So I with regards to the inputs we just talked about, it has a little bit of level 2 inputs and then level 3 inputs. That is the asset, or there is no active market. That is one thing I observed. And then
that erases level 1 out, right? That takes level 1 out.
Yes.
Because
that takes level 1 out.
Yeah. So you are left with level 2 and level 3, as you said. Okay, go ahead.
Yes.
So which one will be the level 2?
And then
which one will be the level 3 value? So we pick one.
The level 2. Yes. So the normal sale in the present climate and the expected yield based on the analysis of the transaction, I think would be a level 3, because they are forecasting that if it's being sold, this is what they might get from the sale of the asset. And then with the valuation model, it says it will generate an amount of 12 million over the next 3 years, which is also a forecast they are making. So I think the level 3 inputs would work for this question.
So which one are you going for? We need the value. The question says the amount we should state. So which amount are you? Answer the question as it has been asked.
Okay, so I would go for the 12 million.
All right. So Makafui says 12 million. Yes, and she has given her understanding of what we've done so far. Yes, who else? So I have Makafui saying 12 million. Yes, who else? Yes. So shoot, I'm listening.
Okay, so the point 3 indicate that there's no active market. So if there's no active market, and saying that, however, the company, has received an offer, but for fair value, we are looking at the current existing prevailing prices. Okay, so with that one, I will not go for that option, and the valuation model too, I will not go, because that's also expected in the future, which
the 12 million, right?
Yeah, 12 million. Yeah.
Okay.
So the what I will opt for is the 6 million, which is the the form. Okay, which so a normal sale in the present climate could be reasonably expected to yield 6 million based on an analysis of transactions in similar assets. So if we are looking at similar, we are pegging it with similar assets, like we learned earlier on. If it's not identical and we have similar this thing, we can also peg it at that model. So that's what I will go for.
Thank you very much. And that's the correct analysis. You see, per what you've told me, and the way you analyze it, you actually did it according to what you've heard in class. And that is how your exams is going to be and how you analyze everything. Is it difficult? Let's be honest. Is this thing difficult? If you
No, sir.
listen carefully, is it really difficult?
No, sir.
So in your exams, what you are going to see is these kind of things, and they'll be bringing in tricks. But since you actually understand what you've done, you don't care what the tricks they bring in. So your job is to really get the thing and understand it. All right. So that is the thing. And my job is to guide you to understanding it. All right. So Makafu, you were close. So this one, yes, indeed, is the future cash flow, and it is level 3. This one is, and when I was even reading the question, I told you take note of this similar asset. That even should remind you that that is a level 2 concept. A normal sale in the present climate, all right, could reasonably be expected to yield 6 million based on the analysis of the transaction in similar asset. All right. So now that when you pick this, so it means that it wasn't difficult for you to cut off this one because there is no active market. And it says that it even have no intention of accepting it. Of course, without that one tells you that there is no activity in the market for him to do that. And so you are stuck with the level 2 and the level 3. In fact, you choosing level 3 is okay, except that the standard said that priority must be given, the lowest priority must be given to what? Level 3. And the highest should be level 1, then you come to level 2. Now, in the end, watch this. You people have heard of cases of Enron, all right? Cases of Enron. You people have heard of Capital Bank, all those big companies, Silicon Bank collapsing. You know what they did? They did this. Fair value. They fair value their assets using level 3. That is what they did. Meanwhile, they were level 2. So they jumped level 3 and level 2 and level 1, and they used what they think they will be getting in future times to put into their financial statement. Now, when the economic situation now jump, it jump, that we know that this, see, you say that you get this thing, 12 million in the next 3 years. You say it will recover. See, let me testify something to you, something that happened to me, funny, and it's sad. I have money in the bank, big money, and I've been wanting to go and withdraw it. And it is in an investment. You know, all that thing happened to all of us in this year, last year, this year, where finance minister has done domestic debt testing. Last month, I saw my money and I said, oh, okay, this thing is getting closer. So this month, I'm going to withdraw the money. So I got my statement last 3 days and I realized that the mark-to-market value of my own money has now slashed. I'm not going to tell you my money, but let me give you an example. The bank is telling me that if I had 100,000, I contributed my 100,000 and they gave me interest of, let's say, 20,000. So it means that the total money that I have in the bank is like 150,000. They said if I'm going to withdraw, I will get 80,000. The present value of this is 80,000. Come on, what do you think I should do? So now I felt like crying. So, and that is what has happened. So some banks, you see, some banks, and this thing, the difference between this one and this one is a huge impairment loss. Okay. Some banks have decided to stick to this. That is what they did. And in fact, they have even done a VIU, value use of what they think they will be expecting and PVing that value, even more than this 120, and has gone to like, let's say 400,000. It has made their books look so good. But you and I know you have learned fair value. So the next time you hear of these issues in the system, you that are a professional should be able to understand that the more than somebody who is not doing accounting. So that is the essence of what we have done. All right. So that is that. So this question says that an asset is sold in 2 different active markets at different prices. an entity enters into transaction in both markets and can assess the price in those markets for the asset at the measurement date as follows. So we say that the price is 26 in market 1, then 25 in market 2. Then there is transaction cost. Here, this market is 3, this one is $1. Then we have transportation cost, 2 cedis, $2 here, $2 here. So the transportation cost kind of cancels out itself. All right. Then we come here. It says that what is the fair value if market 1? What is the fair value of the asset if market 1 is the principal market of the asset? And what is the fair value of the asset if there is no principal market? Okay, so that's the question. So number 1, the value of the asset if market 1 is the principal market, and the value of the asset if there is no principal market. Yeah, so if the market, what do you call it? The principal market is market 1. What do you think will be the value of the asset? So we focus only here. This one, market 1. What do you think will be the value? Yes. Yes.
It will be the price, 26.
Only the price.
Yeah.
Which is 26. Yes. Any other person? Any other person? Yes. 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 Any other person?
24.
24. In fact, 24 is the correct one. The 26, you forgot that transportation cost. You remember? Carriaging was any other cost incurred in bringing the thing into each useful state. So it's 26 minus. Hey, sorry. The fair value is 24. Yes, it's 20. This one is 26 minus 2. Yes, that is what I mean. Watch this. Who remembers what we said about the transaction cost? Who remembers? So it means that when we say transaction cost, it probably, sometimes this transaction cost has this one. The price of the asset itself without it carriage inwards. That is where I was mistakenly going to add, but that is not what we are talking about. If you remember what we said here, please watch this. I'm going back to the board. I nearly used IAS 16 to even do this. Watch this, what we said here, 24. If you check this one, most advantageous market and principal market. All right, we said that the transaction cost and all these things, fair value is not adjusted for transaction cost. Okay, so that one is not adjusted for it, you leave it out. All right, so the other one that is inside that you have withdrawn is the factor. So it is the 2, which is the transport cost, because the transaction costs are ignored as they are not a characteristics of the asset. It is already ignored. They are not a characteristics of the asset. So ignore that one. So you pick your 26, you ignore transaction cost. Then the only one, you see, the two that we are taking out is additional cost. It's additional cost. But if you want the price of that thing as it is the 24, which means that you are going to take the 26 and take out your what do we call it? Your 2, all right, and get 24. Please, once again, remember, transaction costs are ignored as they are not a function of the asset, but a function of what? The market. Please take note of that. It's very, very important. Very, very important. So when we are doing principal market, you ignore the transaction cost. But when we come to, what do we call it? The most advantageous market, that is where you need to be careful. The most advantageous market. So in the most advantageous market, let me see if somebody can catch that one. Because in the most advantageous market, we said that we want the place where we can get higher money, all right, is the most advantageous market. So if you don't have a principal market, which one will you go for? Most advantageous, right? Is that not it?
Yeah.
Exactly. So now if there is no principal market, the question said that there is no principal market. So what is the value of the fair value of the asset if no principal market can be determined? Okay, so if no principal market can be determined, what do you think will be the value of the asset? What do you think will be the value of the asset? Which market will be the most advantageous anyway in the first place if there is no principal market? So these two are deep market one, market two. Which one? So if there is no principal market, we are looking at the most advantageous market. And if we are looking at the most advantageous market, which of these two markets is most advantageous?
Market two.
Market two.
Market two. And if it is market two, what will be the price, the fair value at market two?
It will be 23.
23. It will be 23. Yes, exactly. I think you are now getting it, guys. Kudos. You've done well. All right, you've done well. Let's look at this last question. This very last. All right, so let's look at this. All right, so look at this one. So we have 5 quarters. 5 quarters has purchased 100% ordinary share in 3 halves and is trying to determine the fair value of the net asset at acquisition. Please, this one, if you don't get it correct, I get you, because it's consolidation, okay, console, and we'll be using, when we get there, we will see it. Because I told you that fair value, IAS 13 is applicable in IFRS 3, business combination. So this is what we call business combination. Now, it says that 3 halves owns land that is currently developed in for industrial use. The fair value of the land, if used for manufacturing operation, is 5 million. So that one is there. Then it says that many nearby plots of land has been developed for residential use. So here, when you are using it for manufacturing operation, it's 5 million. Many of these things are, many of the nearby plots of land has been developed for residential use as high-rise apartment buildings. The land owned by 3 halves does not have planning permission for residential use. Okay. Although permission has been granted for similar plot of land. In fact, there is something that we learned when it came to non-financial. And I made a statement there. I want to see if you guys remember. If you remember. And I told you that PPE, intangibles, and inventory are part of non-financial. And I gave you 3 things be over there. I want to see if you can reason that into this. So it says that the fair value of 3 halves land as vacant site for residential development is 6 million. However, transformation cost of $0.3 3 million would need to be incurred to get the land into this condition. How should the fair value of the land be determined? Yes, who can try? Per what we said, if you remember something, try. Yes. Remember, this thing is a non-financial non-financial, and I said some things there. If you remember, if I want to guide you more, I said that if it comes to non-financial, we use the best and highest use. And there are 3 things in determining the best and highest use. Do you remember?
Yes, sir.
Yes.
Yes. So one of them was financial, right?
Yes, sir.
The other one was legal permissibility. What was the first one?
Yes, sir. Fiscal possibility.
Fiscal possibility. No, now interpreting that thing in this figurative question, how will you determine your fair value? How much do you think is your fair value? So you realize that the highest and best use of the asset will be which one? Is it to be using for manufacturing or to be using for residential? Residential. Now that you know, okay, right now you know it's residential. go to the next step further. Okay, so the three things: physical condition, okay, fine. Financial feasibility, legal permissibility. Do you see that? What did I say about the legal permissibility? If you remember, I said it doesn't matter whether it is illegal. Do you remember?
Yeah.
Yes. So you don't use the fact that he doesn't have the permit because he's not actually going to build it. He wants the price. Are you getting it? He wants the price. He wants to determine price. So it's not about whether he's going to use it to build it so that obey something illegal. It's just determination of the price. So we said that that factor doesn't matter. All right, whether it is legal or illegal. So now that you understand that, and you've already, you see, so here you have 5 million, and the best use is 6 million. And don't forget, it will cost him 0.3 million for him to be able to get the land into the physical condition, that condition. So you see, on the other hand, you have this, you have 5 million on one side, the other one, you have 6 million minus 0.3 million, which will give you what? 7.7 million. Therefore, the fair value that is applicable is what? 5.7 million. If you have done this calculation, all right, after doing this calculation, you see this thing, this one that we deducted is just like the transportation cost. Do you remember the one we just did?
Yes, sir.
Yeah.
So if after we are done that, this thing go to like 4.9, which one would you think have been our most advantageous?
The 5 million.
Jupiter,
The 5 million. So guys, honestly, this is your exam. So it's up to you to be able to pick up the piece and the pieces and put them together and answer the question. All right. So that is how the exam is. This is ICA for you. So you see, it causes you to think, it causes you to reason more. All right. So that is it for you. I hope he's enjoying.
Yes, sir.